Hi, this is Mike Maloney with Ronnie Stroferle once again, and Ronnie's got some great insights and some great charts to share with us. Ronnie, how are you doing?
Very well, Mike. Good to see you again.
Okay, so you've got M2 and the CPI, how highly correlated they are here on page number 12. Tell us about this.
Yeah, well, I mean, there's a very close correlation between the development of M2, and we calculate M2 per capita and inflation. And as you can see here, well, actually, we saw it in the 1920s, we saw it in the 1930s, the very high correlation. Then, of course, since the year 1971, we're seeing much less volatility of the CPI. But we also saw it in 2008, 2009 that they were highly correlated. And now M2 per capita has risen significantly, while CPI has only risen a bit, and we use a moving average of CPI for this chart. But I think at some point we will really see nasty CPI surprises, and I think that now at the moment, I think that the Federal Reserve will face increasing pressure because market participants are realizing that it is not transitory. Well, Mike, I not only talk to financial market guys, thank God. I talk to business owners, I talk to private individuals, and so on. And everybody is telling me that they fear that they see inflation, that they feel it, that it's coming from all different sides. If you're talking to people from the building industry, if you're talking to people from the service industry, where most of them say they have a hard time filling positions, especially for skilled labor. We're seeing that freight rates are going through the roof. A friend of mine, he works for a company that needs quite a lot of containers, and he said last year the freight rates were $3,000 for one container load. Now they are 13,000, and of course somebody has to pay it, and it will be the consumer. So from my point of view, it's pretty interesting, because over the last couple of years we were always told by central bankers that inflation is too low. We were always told that they will do whatever it takes to get inflation rates up. Now inflation is up, but they keep telling us that it's transitory, so they have more leeway to do more. And as we know, they introduced this average inflation targeting recently in the US, but now also in the Eurozone. So I think I don't expect hyperinflation going forward, but why not inflation rates staying up at 4, 5, 6% over a couple of years? I think this, in combination with yield curve control, might really be the solution going forward. And as you know, we always study history, and as you can see, for example, on page 14, this shows the velocity of money. And actually, the velocity of money has collapsed last year. And we're seeing now lower levels than in the years 1933 or 1946. Now, what happened in 1933? Well, we saw pretty radical measures. The US government devalued the US dollar versus gold. And in 1946, they basically introduced yield curve control. So they pegged interest rates at a certain level. I think on the long end it was 2.5%, and this, in combination with higher inflation rates, of course, this has an effect of the on the debt situation. Now, I know that forecasting the velocity, or as Austrian economists call it, the demand to hold money, is pretty tough. And my friend Russell Napier, he said forecasting velocity is really difficult. It's like trying to juggle an incontinent squid something you really don't want to do, and you're very unlikely to be successful. But from my point of view, velocity, now that we're seeing more confidence coming, that we're seeing that the worst of the whole COVID crisis is basically over, that people start doing capex again, they start traveling again, they start consuming again. I think that velocity will start rising. It has already stabilized, and it will meet a flood of liquidity that was created over the last couple of months. So this is the recipe for rising inflation.
Yes, I believe you're absolutely correct. I do want to point out some things about how the last set of charts here correlate, because this is my episode 7 of Hidden Secrets of Money, where I talked about the Weimar hyperinflation, but how the anxiety of World War I, with Germany's borders toward the end of World War I collapsing in on them and their sons being killed, and they would save every penny that they were paid. And so even though the government was creating huge quantities of currency, velocity of currency was slowing to offset that even more than they were creating. And they actually had a little bit of deflation toward the end of the war, even though the currency supply had basically, they had added 400%, I believe, to the currency supply. It was 5 times larger than it was before the beginning of the war. And all of that currency acts like a battery. It's charged up. And you said, trying to control velocity is trying to juggle an incontinent squid. I love that terminology and imagery. The Federal Reserve and the world's central banks cannot control velocity, because velocity is all psychological. It's all the mood of the public. Are they feeling good? And if they are feeling good, they go out and spend, and they take a friend to dinner and stuff like that. If they're feeling bad, they stay home and they eat rice and beans. So it all has to do with levels of anxiety. And if you go back to page 11 here with the year-over-year change of M2, and you look at that enormous spike that is the biggest, this chart goes back to 1960. This is really, like we said, the death throes of a monetary system. So that's the increase in quantity of the currency supply. And then the next chart, how that correlates to the previous chart, you've got this CPI year over year and M2 per capita. So you've done this per M2 currency supply per person change year over year. And that huge spike, but the CPI has not caught up yet. And you pointed out that this is a moving average of the CPI, so you can't yet see the change. But remember that the CPI was only up at about 5%. We've got close to a 30% year over year change in the quantity of currency in the M2. The next one, US savings rate. This is what is slowing velocity. When your currency goes into a savings account, it's parked. It's not moving. So the velocity is 0 when it's in a savings account. And this is all disappearing. All of the currency that this world central banks have been creating was disappearing into savings accounts because of the anxiety that people had over COVID-19 and the lockdowns and the slowing of the economies and stuff and all of the unemployment. So people got scared. They were saving it, just like during World War I, the end of World War I, when everybody in Germany had a lot of anxiety and they were scared. And then you show that velocity. The velocity fell off a cliff on page 14 because it went into, even though they're creating more currency, a lot of it stopped circulating because it ended up in savings accounts. And then on page 15, you say as soon as velocity starts to rise, and this is M2 velocity and the inflation rate. And when that velocity rises, this battery of all the Fed cannot decide to just take the currency that people have in the Fed, the world's central banks, that people have in their savings accounts, these storage accounts, these charged up batteries. The world's central banks have no control whatsoever. They cannot discharge the energy that is stored in everybody's savings account and bank checking account. And that's where all of this currency creation went as this velocity. That's what slowed down the velocity. When that decides to come out, that is exactly what happened. You know, after World War I, the German government stopped printing currency for a little while, but there was a 700% pre-hyperinflation inflation before the big hyperinflation that happened in 23. There was a hyperinflation, and prices rose by 700% as all of that currency that had been stored up during the war came out of hiding. So, you know, you said that you don't think there will be hyperinflation, but I think that there's actually the potential of approaching those levels at least. Double-digit inflation is highly possible. What's your thoughts on double-digit inflation?
Of course it can happen. Of course it can happen. And then I think the big question is, how is the Federal Reserve going to react? Because then, I mean, I think there is no way that they find a way not to increase interest rates. Now the big question is, what's going to happen to the bond market then? What's going to happen to equity markets then? So this is really the trap that the Federal Reserve is in now, and that central banks in general are in now. And of course, I think that the main reason for that is that they have completely underestimated the time lags that affect those processes. And now I really think, as I've said, I think it shouldn't be left to academics and statistics. I think it's really important to talk to people, to business owners, to investors, of course, to private people, and I just feel that a wage price spiral will soon start. So I think this is really the big next topic, because people say, well, you know, everything just costs significantly more. You know, have a look at fuel prices, college tuition, social security expenses, eating a dinner out, whatever. Costs are really rising between 7 or 10% for those things that are important. And at some degree, people will say, well, you know, we want a higher salary. So this whole wage price spiral will start, and it will accelerate at some point. And therefore, I think that, you know, something that for a mainstream economist is absolutely impossible, stagflation, might be something that we will talk about quite a lot in the future ahead. So we all know, and we did a huge amount of work on stagflation and what it does to your portfolio. So that should even further improve the situation for gold.
Yes, you know, you talked about the bond market or the equities market. The Fed is trapped because if they raise rates, the governments can't refinance their debt and everything crashes. And if they raise rates, the stock market collapses. If they don't raise rates, the way they keep bonds down when nobody wants to take the risk to buy them is for the central banks to buy the bonds that the government is issuing. So they have to buy more and more and more. And when they do that, it creates currency. So it goes into this positive feedback loop of just ballooning the currency supply and creating enormous inflation eventually. As soon as currency becomes a hot potato and people don't want to, and you know, with inflation rates where they're at, these savings accounts eventually will become a hot potato. And I do see the possibility of them going in, the inflation rates going into double digits. Then the Fed, the ECB, everybody, the world's central banks really do have to raise their interest rates, but if they raise their interest rates, they crash the stock market, and then you go into deflation.
Yeah.
They are so trapped. It's just amazing. There's nothing they can really do to get out of this, but the individual can get prepared, because these events in history that are generally bad for the majority of the people are very good for the people that are prepared. So I want to tell everybody, research this, come to your own conclusions, and get prepared. I want to thank you so much, Ronnie, for your time, and we'll see you in the next edition. Thanks.
Thanks. See you soon, Mike.